Good evening, everyone. Today we're looking at corporate reporting. Under corporate reporting, we'll be looking at IFRS 13, fair value measurement. Now, fair value measurement, because of there is no specific definition of fair value measurement, and different standard define its own fair value measurement. So the ISB issued IFRS 13 in order to address fair value measurement. Now, the ISB has adopted a fair value method to measure assets and liabilities in its IFRS accounting standard because the historical cost conversion was not consistent with the underlying quantitative characteristics of relevance. So the issue was the, the issue was therefore no definition of what fair value actually was until IFRS 13 was created. So there's no definition of fair value until the creation of IFRS 13. So IFRS 13 are defined fair value for us. So let's what is fair value based on IFRS 13? Fair value, the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So the price that you will pay to sell an asset or you will transfer a liability between market participants in an orderly transaction. That means it will be on an arm's length at the measurement date. Whereby fair value means that both the seller and the buyer must have must be knowledgeable in terms of the item they are buying and selling. That is by that you say okay that asset was purchased at its fair value. Not that you go and buy an item in which it's only the seller that knows the price. The buyer does not know the price. So that one is not at the fair value. It must be the price at which the buyer and the seller they knows the price. That is the price is known in the market. So nobody can cheat each other. So we're saying that price is the fair value of that item. Now, IFRS 13 adopt a okay. We were shaking it up before 6 o'clock. Okay. Why did we go there? Why did now, we said IFRS 13 define an active market as a market in which transactions for the asset or liability takes place with sufficient frequency and the volume to provide pricing information on an ongoing basis. If an active market exists, then it will provide information that can be used for fair value measurement. If there is no such active market, e.g., for the sale of an unquoted business or surplus machinery or surplus machinery surplus machinery, then evaluation techniques would be necessary. Now we are saying where there is no active market for a particular asset, then you can use your valuation techniques. Where the asset is unquoted, you can use what valuation techniques. Now, the principal or most advantageous market. Now, the fair value measurement is based on a possible transaction to sell the asset or transfer the liability either in the principal market for the asset or liability or in the absence of a principal market in the most advantageous market for the asset or liability. Now, We are saying that the fair value of an asset must be determined or must be derived from a principal market. Must be derived from a principal market. From a principal. Now, in the principal market only identify transportation cost. If transportation cost is needed, or if location is a criteria for the sales of that asset. Note Note that if there is no principal market for the asset or liability, the fair value measurement must use the price in that market, even if a price in a different market is potentially more advantageous at the measurement date. Now, if there is a principal market and there is another market, if it's a most advantageous market, we're saying that the fair value of the asset must be the price in the price of a principal market. That means if the market price is lower than most advantageous market, then you must use the principal market price, that lower price, because the standard sales the principal market first before most advantageous market, before the most advantageous market. Now, transaction cost, because IFRS 13 define the meaning of transaction cost. So in our exam, that's also differentiate between the principal market and the most advantageous market. We should be able to use this transaction cost as a criteria to differentiate them, because the principal market does not use transaction cost, because in the principal market you don't need a professional to tell you the price of that asset in that market. You don't need a valuer to tell you the price of the asset in that market. That means the price is already known by the buyer and the seller. Transaction cost. The price in the principal or most advantageous markets used to measure the fair value of the asset or liability is not adjusted for transaction cost. That means in the principal market you don't adjust for what transaction cost. So a it's not price being recognized in arriving at your fair value using the principal market. Fair value is not Fair value is not net realizable value. That means we are saying that fair value is not the same thing as what is being divided by IES 2, or fair value less cost to say. Fair value is not the same thing as fair value less cost to say in accordance with IES IES 36, and uses the price that an asset can be sold for as the basis for fair valuation, does not mean that the entities intends to sell the asset or sell it. Transact Transport cost. Now, if location is a catalysis of the assets, the price in the principal or most advantageous markets is adjusted for the cost that would be incurred to transport the asset from its current location to that market. So we are saying that if location is a catalyst in the market or in the asset to be in which you want to sell, we are saying that location, that the transport cost, must be deducted in the fair value before arriving at the entity's own fair value. Now let's look at this illustration as simple as it is. Illustration 1. An entity owns an asset that will be sold in one of two markets. Information about this market and the cost that would be incurred if sales were to be made is as follows. So we are giving the sales price, we are giving the transport cost, we are giving the transaction cost, and the net amount received. Now you are required. What fair value would be used to measure the assets the asset if market A were were the so you are required. What fair value would be used to measure the asset if market A were the principal market? B. What fair value would be used to measure the asset if no principal market were could be identified? Now let's solve this question together. Let's solve the question together. So illustration one. Illustration one. Say 1A. It is calculation calculation of fair value of fair value of fair value if market A market A market market A is the principal market. The principal market. The principal market. Now, when you talk about the principal market says the principal market does not recognize transaction cost. So the fair value will be your sales, your sales price, your sales price, your sales price, which is 260, 260 less less transport cost, less transport cost. So what is transport cost? Transport cost is 20. So the fair value. So the fair value. So the fair value is what? 240. The fair value is 240. So in our question, we don't have to leave like this. We have to explain why it's 240. We said because in the principal market, does not recognize transaction cost. So market A is the principal market. So that's the reason why transaction cost does not form part of the fair value. Now, for B, for B, now for B says where what is the fair value if no market is the market? It's very simple. Here we don't need to calculate anything. We just need to explain because they've already calculate everything for us. Now, it said if no market is the principal market, the fair value if there is no if there if no market if no market is the principal market is the principal market is the principal market then then the fair value then the fair value will be the will be the value the value will be the value of the most most advan advantageous advan advantageous market. And this market is where the highest is the highest value and the best use of the asset. That's a advantage market. The two price, you look at all markets, which market has the higher value or the highest value, and is the best used of the value of the assets. So we say is a market B. Market market B is 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 the highest and best and the best and the best is the highest and the best is the highest and the best use of the asset. So is which is which 22. So with this we've solved this illustration. So let's explain further. Let's go back to our notes. Let's go back to our notes. Let's save it. Let's save it to. Let's save it. Ifrs 30. So let's go back to our notes. So let's explain further so we can solve other questions. Now, fair value of non-financial assets. The fair value of non-financial assets, or further comments, or fair value of an asset. So where there is other characteristics to that asset. So this must be considered before arriving at the fair value of such an asset. Now, the fair value measurement of a non-financial asset must value the asset as its highest and best use. That is why we use the highest and the best use, which is the most advantageous market. This must take into account the use of the asset in its physical position. So before you can arrive at the best use of the asset, because you must look at the fair value of non-financial assets, which is land or any asset, which is land or any asset. You must look at the two use of that asset. Okay, an asset want to be used for this, I want to be used for this. Out of the two use, the best use, the one that will have the highest value will be the fair value of that asset. But you must consider all these criteria. One, physical physically possible. What is the physical characteristics that market participants would take into account when pricing the asset? So before you can look at the best use of an asset, you must look at the physical characteristics of market participants. So that means the condition the buyer we always buy the asset. Two, legally permissible. Legally permissible. Any legal restrictions on the use of the asset that market participants will take into account when pricing the asset, e.g., the zoning regulations applicable to a property. Now, legally permissible. That means before you can look at the best use of an asset or the fair value of an asset, you must look at the legal permissible of that asset. Is any restriction? That means, for example, now you want to sell a vehicle. A vehicle must have a document. You must prepare the paper for the asset. You must have the plate number. For example, if it's a already used vehicle. So all these are legally permissible. Is it what the law of the land requires. So you must ascertain that before you can sell the asset. If not, you must remove the cost from that asset. Financially feasible. Whether a use of the asset that is physically possible and the legally permissible generates adequate income or cash flows or cash. Now, valuation techniques. Now look at valuation techniques. But before that, I'm talking about financially feasible. We said whether a use of the asset that is physically possible and legally permissible generates adequate income or cash flows to produce an investment return that market participants would require from an investment in that asset, but to that use. But to that. So, well, let's look at valuation techniques. Now, the objective of using a valuation techniques is to estimate the price at which an orderly transaction to sell the asset or to transfer the liability would take place between market participants at the measurement date under current market conditions. IFRS 13 requires that one of three valuation techniques must be used. That means if you want to use valuation techniques, yeah, IFRS 13 gave this approach whereby you can use to value the asset. One, market approach. Now, to value your asset, you can use market approach. So you use price and other relevant information from market transactions involving identical or similar assets and the liability. That means if you want to sell an asset, you can use the price of similar assets or liability. Cost approach. The amount required to replace the service capacity of an asset. That means the replacement cost. That means if you cannot use the market approach, you can use a what? The replacement cost. Then income approach. So the way you can use to value valuation techniques is either use the market approach, use the cost approach. That means you can look at the fair value of an asset. It's either through the market approach, through the market price of similar item, or cost approach through the cost you will use to replace such an asset or its service capacity. Then the three is what? Income approach. Convert future cash flows. That means another how you can actually arrive at your fair value of an asset is you must convert the future cash flow. That means all the future cash flows of that asset. When you get the future cash flow, you have to convert it to a single current amount. So I want to discount it to a single current amount. Now, an entity must use evaluation techniques that is appropriate in the circumstances and for which sufficient data is available to measure fair value, maximizing the use of relevant observable inputs and minimizing the use of unobservable inputs. Now, so we are saying you can use any of the three approach, but the one that is available for the entity at a particular circumstances, that is what they will use, or the one that the data is available, that is what they will use. If it's the income in which they can ascertain the future cash flow from that asset, then if everybody can arrive using income approach. Now the bid and offer price. Yes, the IFRS also talk about bid and offer price. The bid and offer price. For some assets, liabilities, market quote, price that differ depending on whether the asset is being sold to or bought from the market or bought from the market or bought from the market. The price at which an asset can be sold to the market is called the bid price. Yes, this is people that we in the professional stage or the final stage will be familiar with bid and offer price, because the bid price the bid price eh, is the price at which an asset could be sold to the market is the bid price. Why offer offer the price at which an asset could be bought from the market is called the ask or the offer price. Is called the ask or the offer price. The ask or the offer price. That means for the dealer now, for a dealer. So for the dealer, if the bank is the dealer, let's use the bank as an example. Yeah, I'm using individual as an example. If the bank is as example, which is the dealer, the bank, the bid for the bank, that means the reverse is the case for this for individual. The bid is the price the bank, the dealer will purchase an instrument. Why the offer is the price they will sell an instrument. Why for you is opposite. The offer is the price where you purchase, and the bid in which you will sell. Now let's look at the fair value hierarchy. Fair value hierarchy. Fair value hierarchy. What's the fair value hierarchy? IFRS 13 establish a fair value hierarchy to categorize inputs to valuation techniques in three levels. Now, saying what are the three levels? What are the three fair value hierarchy? In our example, it asks us list the fair value hierarchy and explain them. You should be able to explain this fair value hierarchy very well. They are three. They are three. Now, let's look at the first one. Level one, the input. Level one, inputs quoted are quoted price in active market, frequency and volume. Like an active market is a market whereby is a market of frequency and volume. That is, large volume of transaction is being conducted in that market. For an identical asset or liability that the entity can access at the measurement date. A quoted market price is an active market provides the most reliable evidence of fair value and it's used without adjustment to measure fair value whenever available with limited exemptions. So we're saying the level the level one is that if you want to sell an asset, you must first of all identify the active market first. The active market, what is the price in the active market? And an active market is the market of frequency and average volume. For example, Jumia, those that live in Lagos, let me take a Alaba market. It's an active market. They will call you will see a high volume of the item is being sold there, and it's on frequency. It's every day. You can get it anytime. At the time in which the market is being is being is being slated, you will get the item there. So we said the first level, the first place you can look for is the active market. Two, level two, inputs are inputs other than quoted market price included in level one that are observed for asset or liability either directly or indirectly. Level two inputs include the quoted price for similar assets or liability in active market. Now, if there is no active market for the asset you want to sell, you will look for the quoted price for the similar asset in an active price in an active market. If that one is not possible, if there is no quoted price for similar item in an active market, you now look for the quoted price for identical or similar asset or liability in market that are not active. Then you now have to go to the most advantageous market, or you use the most advantageous market, or use the highest or the best use of that asset to identify your um fair value. Or if there is no most advantageous market, you can go to use the C for in level 2 said inputs other than quoted price that are observable for the asset or liability. For example, interest rate, yield curve observable at commonly quoted interval. So you can use the interest rate to determine the fair value of that asset. Now, this is the last level you can use, level 3. Unobservable inputs for the asset or liability and cover the scenarios whereby there is little, if any, market activity. An entity an entity develop develop unobservable inputs using the best information available in the circumstances, which might include the entity's own data, taking into account all information about market participants' assumptions that is reliably available. So, for you to, if there is no active market, no most advantageous market, no active market for similar items, then you cannot use your own unobservable inputs using all data available to you to derive your fair value. But you must ensure you consider the assumptions of market participants. Now let's look at illustration 2. Um, November diet 2016. Question 4. Question 4. Question 4. Let's look at that question. Yes. Now, if you look at this question 4, you find out that I can repeated this question, the one we saw before, to just they repeat similar thing. They repeated the same question. Now let's look at the question together. Question 4. Prior to the advent of IFRS 13, many standards such as IS 16, IS 38, IS 40, and IS 39, among others, require the use of fair value. So many standards talk about fair value, but they have different meaning. These various requirements have been harmonized with the introduction of IFRS 13 fair value measurement. You are required define fair value in accordance with IFRS 13. In accordance with IFRS 13, 2 marks. So using the notes given to us, we should be able to define the fair value. We say the fair value of an asset is a price in which an asset will be sold or a liability will be transferred in an orderly transaction between market participants and the measurement date. That is 2 marks for you. Now, this B is what we saw before. So I won't solve the B again. Though what we need to know, yeah, just to understand it, just we need to understand it more and explain more. They said the B part, one one of the companies formerly operating in Nigeria that had recently relocated its operations to Ghana as a result of challenging business environment in Nigeria, has access to both Lagos and Accra markets for its products. The products sells at slightly different prices in Naira in the two active markets. and entities enter into transactions in both markets and can access the price in those markets for the product at the measurement date. So I give a price. One, required. Briefly explain the principal market of an asset in accordance with IFRS 13. So we should be to explain a principal market. A principal market. Determine the fair value would be would be used to measure the sales of the above product if the Lagos market were the principal market. Now, if Lagos market is the principal market, remember that in the principal market, transaction cost is not a characteristics of active market or principal market. So the fair value in Lagos will be 260 minus 20, which is 240, which is 240. Now, how is fair value determined in absence of a principal market? Remember, I said when there is no principal market, you use most advantageous market, and the most advantageous market will be the market in which has the highest and the best use of the asset. So the highest value is your most advantageous market, or will be the best market. If you look at it in both of them, and remember that in your most advantageous market, transaction cost will be deducted. So Accra will be the fair value, which is 220. Now, when we want to solve is this illustration C. C is where I want us to solve based on our knowledge in IFRS 13 for the C. For the C aspect now, for the C aspect now, for the C aspect, so let's read it very very well. Let's read it. I'm giving us um 3 minutes to read up the question. Megida PSC. So Megida PSC. Now let's look at a solution. Question 4. Megida, Megi, Megida PSC. Now we are told that Megida PSC has purchased a land in Abuja, and this land can be used for commercial purpose. Can be used for commercial purpose. So, what is the fair value of the land if used for commercial purpose? So let's look at the question again. So a public limited company acquire an acre of land in Abuja for economic development. The fair value of the land if used for commercial purpose. So for commercial purpose. So calculation. Calculation of fair value of land for commercial for commercial purpose for commercial purpose. Now the land, the fair value, so for commercial purpose, what is the fair value for commercial purpose? We are told the fair value for commercial purpose is what? 100 million naira. 100 million naira. So you put 100 million naira. So 100 million naira. And we are told that if the land is used for commercial purpose, it's expected that it will result in reducing unemployment. This will attract a tax credit annually, which is based on the lower of 15% of the fair value of the land, or or 10 million at the current mark, or 10 million, at the current tax rate. And the current tax rate is what? Is 20%. So the tax credit is an income to the company. So say tax tax credit, lower of lower of lower of lower of 15% of 100 million. 15% of 100 million. 100 million. 100 million times 15%. Times 15%. So this will be 15% will be 15 million naira, equals 15 million naira. 15 m, or brackets, or 10 million, 10 million times 20%, the tax rate. 20 million, which is the what? The tax rate. So which one is lower? And this one will give us 2 million. So the lower is 2 million. So the fair value is 102 million. Now we are told that the assets, if used for residential purpose, resi if used for residential purpose, we are told that if that's used for residential purpose, so we are told that the fair value will be the fair value for residential purpose. Now here, the fair value will be what? The fair value, the fair value, the fair value is 148 million. So let's put million here. 148 million. Then we are told that we are going to less legal costs. Legal cost. Legal cost is 4 million. The next one is a viability cost. Viability amount, which is 6 million. We are told that there is a cost to demolition cost. We are calling it demolition cost. because that time will demolish. Shoot, that will be 2 million. So when you add everything together, when you add everything together, this total cost before discount. So the total cost before discount is the total cost before discount is 136. So our discount is 20%. So our discount is 20%, which is less discount. Less discount. Discount is 20%, which is 20%. 20%. 20% times 136. 20% times 136. 20% times 136. So our fair value. So that will be 27.2. So that is your discount. So our fair value, our fair value our fair value is 108.8. Now the answer is the Abuja Municipal or the Megida PLC. Megida PLC. Megida PLC. We use we use 108.8 because 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 is the highest and the best use of the land of the land of the land, because you look at it, is higher than is higher than the commercial use, which is 102. So let's look at the other illustration that I sent. Yes, let's look at this illustration. So energy co please, we can read up this illustration, and I'll provide this to us. Energy co energy co solution. Solution. energy cool, energy cool, or fair value. Now, to calculate fair value for energy cool, or fair value for energy cool, fair value for energy cool. Now, the expected value, the expected cash flow. Now, the expected cash flow will be six times 40% plus 8 times 50%, which is the probability, plus 10 times 10%. So we have 7.400. 7.400. Now we have third party. Third party. Third party contractor markup. Contractor. Contractor markup. Now, this markup, we say the markup is 20%. So total party markup is part of the fair value. So we said is 7.4 times 20%. Then 20%. This will give us 1.480. Now, there is inflation rate. So inflation rate. Inflation adjustment. Inflation adjustment. Now, we are told that the inflation rate is 3% for 10 years. So it will be 8.88 times 1.03. That is the inflation rate for the future period. 3%. So which is in 10 years time. 10 years time. So in 10 years time, so it will be raised to power. So I'm looking for raised to power View. Oh. Mm, mm, okay. Yeah. Yes. So is what's the power? So we have to less it minus 8.88. 8.88. 8.88. Sorry, the battery is low. 8.88. So we have 3.054. 0.54. So when you sum everything together, now the risk premium, you add the risk premium to it. Risk premium, risk premium, risk premium. When you sum everything together, you will have 11.934. 11.934 times 5%, times 5%. Then you have 0.597. 0.597. So our fair value now, our fair value, which is the present value, the PV of future cash flow. Now the fair value of future cash flow here equals to the total value in year 10. When you sum everything together is 12.581 divided by 1.06 raised to power 10. So raised to power 10. So raise to power 10. So raise to power 10. So our answer will be 6.997 as our what? Fair value. So let's look at the solution together. Let's do it again and look at our questions. Thank you for your time and cooperation. Good night.